the silent accounts. In 2023, a leading commercial bank reported record profits, $1.8 billion in annual earnings, the highest in its 45-year history. Investors applauded. The market cheered. But beneath the surface of those glowing numbers lay something darker, an empire built on false credit reports, offshore laundering, and silence bought with power. The whistleblower. It began with a quiet message, an anonymous email sent to the Financial Intelligence Unit, FIU. The sender claimed to be a mid-level officer in Dominion Commercial Bank, one of the country's largest financial institutions. The message read simply, "Check the risk data. The loans don't exist. The profits aren't real. And the losses are buried offshore." The FIU forwarded the email to the National Forensic Audit Bureau, where Dr. Raymond Cole, a forensic accountant and former bank examiner, took the lead. Cole was known for his methodical precision and unemotional style, a man who believed that numbers, unlike people, don't lie. He began with a quiet inquiry into Dominion Bank's risk and credit division. Everything seemed clean, too clean. The bank's loan performance ratio was an impossible 98.4%, far higher than the national average of 79%. To the public, Dominion Bank was a symbol of stability. To the auditors, it was a fortress of numbers no one dared question. The anomaly. Cole and his team began a deep data reconciliation exercise, matching reported loan portfolios with underlying collateral. What they found defied logic. Several corporate loans, worth over $620 million, were issued to clients with no registered business operations. Collateral documents were digitally signed by the same compliance officer, on the same day. Repayment transactions appeared automated, with no originating deposit accounts. Cole knew what this meant. Loop transactions, a sophisticated form of internal recycling where fake repayments are generated to show performing loans. To trace it further, he subpoenaed internal communication records between the risk department and finance division. Buried within thousands of emails, a single attachment caught his eye: Project Wave Summary in an Excel file. Inside, he found a list of 17 offshore entities registered in the Cayman Islands, Malta, and Mauritius, each marked as asset-backed investors. But the corresponding cash inflows were never reported in the central banking system. The internal cover-up. Cole arranged an interview with Laura Mendel, the bank's head of compliance, a seasoned executive with 20 years in regulatory oversight. "Cole, we've identified several inconsistencies in the loan files. Are you aware of external investment entities called Project Wave?" Mendel pauses. Project Wave is a legacy portfolio. Pre-merger. Off-balance sheet funding. Cole, there's no documentation on the central ledger. That's illegal under Basel III. Mendel, defensive, it's complicated. It involves confidential clients and sovereign accounts. Cole pressed further, but she clammed up. A day later, she resigned for personal reasons. Her replacement, David Hargreaves, turned out to be one of the signatures authorizing the offshore accounts. The deeper Cole dug, the clearer the picture became. Dominion Bank had created a parallel ledger system, a shadow network running alongside its official accounts. Within it, executives manipulated credit data, laundered client funds, and presented falsified performance reports to regulators. It wasn't just accounting fraud, it was a systemic deception, crafted by those entrusted with the nation's financial stability. The chain reaction. Cole's team performed forensic tracing on the offshore flows. One transaction stood out, a $38 million transfer routed through Helios Advisory Ltd., a shell company registered in Malta. Helios's listed director? Mark Ellis, Dominion Bank's deputy managing director. Further analysis revealed that Ellis had received consulting fees totaling $4.6 million from Helios over 3 years. The payments were disguised as advisory retainers. Cole prepared an interim report and forwarded it to the FIU and central bank. The moment it leaked, the bank's shares plunged 18%. That same week, 2 whistleblowers were fired. Another was found dead in what police called a home invasion. Cole knew what he was up against, an institution with enough power to manipulate markets and silence dissent. The boardroom gambit. The central bank's governor called an emergency meeting with Dominion's executives. Cole was invited to present his findings. He began calmly, showing slides of falsified transactions, mismatched ledgers, and offshore fund transfers. The room grew tense. Board members shifted uneasily. Finally, the CEO, Richard Cavendish, interrupted. "Dr. Cole, your analysis is misleading. Our offshore partners are legitimate investors. We operate within all legal frameworks." "Cole, then why are those investors also listed as loan beneficiaries? You're lending to yourself." Cavendish, coldly, "That's an accusation, not a fact." "Cole, it's both." A silence fell. Within hours of the meeting, Cavendish's legal team filed an injunction against the release of Cole's report, citing national economic security. But the truth had already started leaking to the press. The digital footprint. A breakthrough came when Cole's cybersecurity analyst, Ivy Tan, discovered that Dominion's internal email servers were synced with a private cloud account accessible only to top executives. Hidden within was a file labeled Q4 Strategy Delta Plan. It outlined how the bank used structured derivative loans to hide non-performing assets, transferring them to offshore vehicles where they'd be reported as high-yield securities. In reality, those securities were worthless. The document also contained meeting notes referencing payments to judicial intermediaries to delay court actions and suppress whistleblower lawsuits. What started as financial engineering had evolved into criminal architecture, a fortress built with layers of deceit and protected by power. The international angle. Cole reached out to the U.S. Department of Justice under the Foreign Corrupt Practices Act, FCPA, framework. With the FBI's Financial Crimes Division and Europol's Economic Integrity Unit, a cross-border task force was formed. Months of joint investigation revealed that Dominion Bank had funneled over $2.3 billion through 11 jurisdictions. The money trail linked back to political campaign funds, private jets, and luxury real estate in Miami, Geneva, and Dubai. In one striking discovery, a portion of the laundered funds had financed an oil deal in Angola, under the guise of a sovereign investment partnership. The scale of the fraud stunned investigators. It wasn't just corporate greed, it was globalized corruption. The fall. In March 2025, the task force executed simultaneous raids across 4 countries. Mark Ellis was arrested in London. Laura Mendel surrendered in Geneva. The CEO, Richard Cavendish, fled to a private island in the Caribbean but was extradited months later. Court proceedings exposed secret ledgers, falsified audit certifications, and bribes to regulators. When the verdict came, it was historic. 5 senior executives convicted for wire fraud, money laundering, and obstruction of justice. Dominion Bank fined $6.8 billion, the largest corporate penalty in national history. The bank's license suspended pending reorganization. But the real victory came when whistleblower protections were expanded through new legislation inspired by the case. For the first time, the system looked inward and saw its own reflection, ugly, corrupt, and in need of redemption. The cost of truth. Dr. Raymond Cole retired quietly months later. When asked if it was worth it, he said, "Truth always costs more than lies. But lies collect interest forever." Dominion Bank was later restructured, its name erased from the skyline it once dominated. Yet for many, the scandal remained a cautionary tale, a reminder that integrity is not an accounting entry but a choice. Moral and call to action. Financial fraud doesn't just destroy balance sheets, it erodes trust, livelihoods, and the soul of society. Auditors, bankers, and regulators hold the power to prevent deceit before it metastasizes into crisis. Protect transparency. Reward truth-telling. And remember, numbers can be manipulated, but integrity cannot.